Hello traders, welcome to FreeFX, your free source of education. Now, this is my trading video today, and it's based on a suggestion from the website babypips.com. One of the forum users has suggested that I provide some particular topics, and one of the topics which I'm going to cover today in this video is the issue of stop losses, how to set stop losses for the for your charts and for your trades. So I'd like to start the conversation by taking a quote-unquote naked chart. So if I can actually start a completely new chart without any lines on it or anything like that, and I'm going to use something that everybody can relate to because it's one of the most popular ones that especially new traders probably approach, the euro and US dollar, because it's obviously a very liquid pair, one of the most liquid pairs in the world because of size of transactions, volume, liquidity. This is the easiest sort of to talk about because everybody's so familiar with it, and obviously because everybody possibly has a sort of general understanding of what the European Union situation is and the American situation is in terms of the monetary policy. There's been a lot of talk on the media, etc. So this is where we start the conversation. I'd like to really take this and consider at a different point. So I'm going to really just rewind the clock a little bit and go to something like let's go to a daily chart, and this gives a sort of clearer view. And I'm going to go to a slightly smaller. There we go. So as you can see here, we are in a situation, and I've sort of gone back a little bit, and I don't know what's happening in the future at this point, because as you can see, I've gone back to sort of August and backwards May, April, March, February. So that's sort of the first half of the year, if you like. Let's do it like that. Okay, so that's 2015. Okay, so we let's say that we didn't know the future, so I'm pretending that nothing happened yet after sort of the end of July here, and I'm trying to make sense of this pair. So if I looked at this from this point on, I would probably go, well, there is obviously a trend here, and it goes something like this. Okay, so let's start with trying to get some visuals in place. Let's say that you are a so-called technical trader. The term is very ambiguous because it implies that people who don't just put lines on a chart are not technical traders, or people who concentrate on the big issues of monetary policy or banks, interest rates, do not pay attention to levels. They do. It's just that some people, especially if they call themselves technical traders, will be people who almost entirely focus on the price in front of them and try to ignore all the hundreds of bits of news that might be coming into a daily on a daily basis, trying to not sort of cloud their judgment so much with that information. But it doesn't mean to say that you shouldn't pay attention. But let's say that whatever you call yourself, technical, fundamental trader, let's say you're looking at this chart and you're trying to sort of make sense of it. So obviously there are different ways of drawing lines, and let's be content with the bottom line here. And the next step is really trying to find a trade entry. Now, one of the forum members has actually said that one of the topics that should be covered is trade exits, which are as important as trade entries. So sort of we incorporate it into this topic, which is really stop losses. But I may do a separate trading video on that topic, which is exits, entries and exits. But this is really just about the idea of stop losses. So at this point, we are obviously we come down from a very long run. Now I can't go forward, but I can go backwards. So let's say if you went backwards a little bit, you can see we come from a long way up, and we come down quite a fair bit. So let's just stick to this. Okay, so we don't know what's happening after this. That's the end of my trend line. So I can just see that it's bounced off, but we don't know what's happening after that. We're going to stick. I'm not going to move the chart, so I know it won't reveal what comes after. I'll reveal that later in the video. So this is just really to see if I do know the future, which obviously we know because we're in October, but I mean, this is where we'll be. So let's talk about stop losses. And what is a stop loss? Well, a stop loss is defined as an order that we put into the system in our trading account so that the broker obliges our order and pulls us out of a particular position. Now, there are different ways of explaining that. Sorry if I didn't explain it in a textbook way. I'm sure that there are different ways of explaining, especially depending on which type of stop loss you are used to using. And this is what we're going to talk about next. What types of stop losses you have? Well, there's the fixed stop loss, where you set a stop loss and there's the mobile dynamic stop loss, okay, a trailing stop loss, so-called. So two types of stop losses. One, it stays where you put it, etc. So let's pretend that I put an entry here. I'm not going to put an entry, obviously, because this is my live account, so I can't really do that. Otherwise, I have to pay for it. So so let's add a line. So let's say that we saw this as our so I'm going to put sort of a darker color at the bottom, lighter colors at the top, okay, and I'm making it a bit thicker. So let's say that this was the bottom end. I have to expand that. Okay, so this is the, okay, that's a straight line. So let's say this is the bottom level where this the Euro USD came down and then started bouncing off, and this is roughly about 1.05. Let's put it, I like round numbers myself. I'll put it up to 1.05. Let's put it up to 1.05. Okay, so it's nice and easy to remember. Okay, it's not exact because it does come down slightly below, but essentially it's 1.05. And then I'm going to put a I put vertical lines as much as possible, and I'm going to put another one here. There's some kind of supply area here, so I'm going to put a little line there and give it a slightly lighter color. So we'll go for a blue and make it also a little bit thicker as well. And okay, so that's where we're at, and that's 110. So 105, 110. Then we have this level here, which is, what level is it? 108. Position 108.50. Let's put 108.50. Okay. And we'll give it a blue as well. Second thickness. Okay, and then we have this. Okay, this is quite important actually. 114.50, I think it is. 114.50. I use either round numbers or half. So 114, 114.50, 115, you know, if I can. So just to kind of, again, keep it simple, really. As they say, keep it simple, stupid. So that's what I do. And that's really where we're at. It's a bit wonky, so I'll make it a bit straighter. But that's it. That's about one. What is it? What did it give? Well, it doesn't matter too much. There's 114.50. Okay, I think that's a little bit more than that actually. Let's put it down to 114. Yeah, 114.50, about there. So these are the levels. We got 105, 110, 108.50, 114.50. Okay, there's a slightly there's another level here. So let's say that we wanted to enter at this point. Okay, and so for that, I'm going to use and that's about 108. Okay, so 108 is our position, and then make that. So for our entry points, I'm going to use a particular color. Okay, I'm going to use a pink, so to differentiate it from, make it different from the others. I'm going to be quite thick. So this is our entry point. This is our entry point. So this is going to be our entry point. Let's say that actually no, sorry. Our entry point is going to be here, where price is 110. Okay, so let's say that we thought that, well, actually 110 is this kind of, so it could be a resistance or supply area. Okay, let's say that we entered here at 108. Okay, 108. So we waited for the price to bounce back down. Let's assume that we already entered at 108, and that our stop loss, depending on what our targets are, could be something like 105. Okay, 108, 105. It's 300 pips. Depending on your rate return ratio, risk reward ratio, and your return of investment, you might want to go 105, 108. That's 300 pips. Double that for my profit level, or take profit. So 3 times 2 is 600. So 108, 114 would be our level. Okay, which is 114.50. So roughly around here, or just before. So our target could be, if we extended that. Okay, so entry, target, and stop loss down here. Now, so you basically get a 1 to 2 or 2 to 1 risk reward. You risk 1, you gain 2, double. Some people say should be 1 to 3, risk 1, gain 3, etc. But it's not really mathematical. It just depends on your strategy. So for this strategy, obviously, we're in the game, and the price starts bouncing up, and we've entered long. Okay, so we start getting some pips here. Now, at this point, we can either, if the market decides at this point to go back and descend against us, we know that our stop loss is around here. Now, it could just come back down to this exact point, depending on the spread, which is the price you pay, obviously, when you buy a position. So buy or sell a position, but when you basically enter a position, you put in an order and you pay the commission. Let's say that your stop loss, those usually for USD, when it's most liquid, might be something like 0.5. But let's say that your spread was 3 pips. So from 105, it could be 1497. But we want to make, depending on your ATR, we want to make sure that your stop loss is at a reasonable distance from the sort of lowest demand zone. This is a demand zone, obviously. It's bounced off quite a bit since then. So this is your bottom kind of demand zone. So we're going to go down a little bit. Well, from 105, we might want to push down a little bit to say 104.50. Okay, that gives you 50 points, nice and clear of that. So even if it just nearly touches there, you're still clear of that. One thing that I would actually advise you to do, again, personal preference, is using the indicator called ATR. So the average trading range. So I'll put it here, ATR, there it is. Average true range, and that comes into the equation here as a daily. This gives you obviously, oh sorry, I've revealed the game there, never mind. Okay, let's put it back to where it was. Okay, so there's your trading range, and we are on a daily at the moment. This is at the moment, so today it's 108 pips. Okay, count without the final digit, so 108. But at this point, so where we are, the entry here, it would have been about 138. Okay, so quite a fair bit higher than today. So about 138. So let's say in one day this could move 138 pips. We've got about 300 and more. So basically it's more than double. So we should be clear. Okay. So that's absolutely fine. But obviously because of where we entered and our sort of stop needs to be clear of this very bottom bit. So always sort of take these are elastic zones. Okay, demand supply zones. They're always elastic. So price doesn't stop dead there. You've got also the spread. So you need to be aware of sort of various things, but I would really just put it on a little bit higher if you could. So if you put your take profit can be a bit more conservative and actually go closer to the edge of that that supply zone or resistance, if you want to call it that. Instead, the stop should be a bit further away from the actual price action, just to kind of make sure you don't get stopped out because of a little flick or a little tail or something like that. During very volatile periods, if your price is close to what would be your stop loss and it whipsaws, then there's nothing that can save you really. You'd have to really change it. And this is something that we're going to talk just kind of right at the end. But just to finish really, let's use fixed stop loss. So let's imagine what happens next is that let's now skip forward and see what happens day after day. So that's about a week after. Price seems to be going up. Okay, and then so let's say you entered at this point, which was the 20th of July, and at this point here on the 21st of August. Okay, so a month later, a calendar month, well, slightly less in sort of okay, we go. So a calendar month later, your profit will be fulfilled. Okay, your position will be filled. Okay. Now, obviously, that would be a perfect scenario. If you had a trailing stop loss, okay, if price moved from 108, okay, to here, for example, 111, that's 300 pips. You're 350 pips. So if you had a trailing dynamic, every pip the price moved in your favor, this stop loss would also move in your favor, or either sort of move up, if you like. But if price started coming down again, the stop loss would have moved back down. It would stay there. Okay. So there are advantages and disadvantages in that if price starts coming down, now you've got a shorter stop loss. So there are two options there. Either you manually then re-lower this trailing stop loss and then wait for price to definitely pick up and let it ride, okay? Or you can sort of let it do its job and stay where it stopped riding and then let it go forward. Obviously what you want is to use a trailing stop loss when you have wider stops, wider targets like this, because if you've got a 500 or 600 pip target, by the time you reach half of it, you break even with your stop loss. And then if it gets to further up, you start getting higher and higher. And then if it reverses, you might even secure half of your position. So that's basically one way of using trailing stop losses versus fixed stop losses. I hope this was a useful video, and please join me for the next video on FreeFX. Thank you.